Welcome back to Do You DADU, the podcast where we explore what's possible in your own backyard. I'm Shakiba, a lead architect with SC Design Build. For our final episode, we are looking beyond the design and construction of a DADU and talking about what happens financially over the life of the property. A DADU may begin as a rental, a guest house, or a home for a family member. But it can also become part of a much bigger financial and estate planning conversation. What happens if the property is inherited? Should it be kept, rented, gifted, or sold? To help us understand all this, I'm joined by Chris Tom, a CPA, Catherine Haggett-Fisher, a Chief Wealth Strategist, and Suzanne Czar, the founder of SC Design Build. Chris, Catherine, and Suzanne, thank you all for joining me. Before we jump into the questions, could you each briefly introduce yourselves and tell us a little bit about what you do?
I'm Chief Wealth Strategist at Fulcrum Capital, essentially responsible for overseeing the implementation of our financial planning with all of our clients here at Fulcrum and helping them decide what are good investments, what are our long-term goals, how do we match our investments up with our long-term goals. So, and rental properties do often come up as we work with clients. So we've seen sort of all scenarios. So I'm looking forward to talking about this today.
I am the founder of Evergreen Accounting, a newer CPA firm that kind of a sole practitioner, but doing comprehensive tax planning, structuring, and understanding the tax implications of different investment and different sources of income, and then planning around deductions and the timing of income and deductions for closely held businesses and the individual owners of those businesses, and then just more comprehensively for folks that are retiring or in retirement, getting ready to retire, and that type of thing. So all around just tax planning and strategy.
Thank you both. A DADU may begin as extra space or rental income, but it can also affect retirement, caregiving, and the way a family passes down property. Catherine, how should homeowners think about a DADU as part of their larger financial and estate plan?
It can be a great diversifying investment, but it is also a very illiquid investment, just like your home, although your home you're living in, and I don't like to think of your home as an investment so much. But a DADU can be a great income producing investment, but again, it's as a diversifier and should not be really the only investment that you have. You really need to make sure that you've got plenty of liquid funds when you're thinking about that situation. So if you think about the pie chart of all of your assets, how much is in retirement plans, how much is in your home, how much is in regular taxable investment accounts, and then how much is in these more illiquid types of investments. It's my job as a planner to sort of think about that worst case scenario. So if we ended up with another 2008, where you might not be able to rent the property, you can't sell it, but you've taken out a loan maybe to cover some of the expenses, you want to make sure that you can carry that for a while without having it rented, without that income stream from it.
Chris, what should homeowners understand about rental income, expenses, and record keeping from the beginning?
Generally speaking, the default for rental income for most landlords is that it is considered passive income. And why that's important is twofold. If you have positive rental income, so your revenue is greater than your expenses, then that positive rental income might be subject to an additional tax called net investment income tax, which adds another 3.8% to your tax bracket, no matter what tax bracket you're in. If your total income is over, $200,000 if you're not married and $250,000 if you are married. And so if you have positive income, then you're going to have this 3.8% surtax at the current rates. If you have losses, that's where people get a little bit in trouble when they start to look at planning around losses. Can I take these losses and offset my W-2, for example? And the answer, generally speaking, is no. If you have rental income, whether it's a DADU or whether it's just a regular rental property, then your losses are subject to limitations called passive activity loss limitations. And so they accumulate, and then you're able to flush them when you get rid of um, that property, or they accumulate, and then when you start to earn income, you can eat into that accumulated loss carry forward. So one thing to just really note is understanding the nature of the type of income that a rental is generating. When you look at a DADU, especially, it's going to come down to record keeping, good record keeping. And the reason is because when you have a property that's part of your overall sort of footprint, your overall parcel, so you're occupying a portion of your property personally and have personal expenses related to that. And then you have this rental income sort of allocated or apportioned to the property. You know, you might be sharing utilities, or you might be sharing property taxes and that type of thing. Good record keeping on what is an indirect expense, so things that you're splitting between personal and the rental, and then the things that are direct expenses. And it's easier to do in the moment than it is to try to figure it out and do once a year. So keeping
Yeah.
track monthly is really helpful.
So shoebox don't count.
Try not to. Your
Yeah.
CPA will thank you.
I have a follow-up question actually for you, Catherine.
Yeah.
When you were talking about the illiquid asset of having a DADU, does it change things if a homeowner were to design it in a way that would allow them to subdivide?
That does change the consideration somewhat. I mean, it's not quite as illiquid as just having it on your property where you can't sell it at all. Having it subdivided, I mean, it's still subject to market forces and is not going to be nearly as liquid as, stocks or bonds. So you still want to be careful and not put yourself in a position where you have this asset that you can't sell, you can't rent it out, and you're tight on cash flow. You're having trouble covering the cash flow. But it does free things up if you can later sell that, maybe to help cover in-home care later. The other potential advantage, and I want to be careful not to start getting into too much of a legal conversation, but if it's a separate parcel, you may be more likely to be able to put it into an LLC and have it as a separate entity. Whereas if it's on your own property, that's much more difficult to do. If it is on your property, you want to make sure that you've got it properly insured and that you probably perhaps increase your umbrella coverage. There's a liability there. Just because it's in an LLC doesn't completely eliminate the liability issues of having a rental, but it helps a bit. And it does, I think, to a certain extent, make the tracking and the bookkeeping a little easier. But I'm going to let Chris, I'll defer to Chris on that.
Here in Washington State, we don't have an income tax on individuals. So whether it's in an LLC or if it's just owned directly, from a tax perspective, there's no difference. I think it does add some separation just optically, like that, you go to the county website to see who owns this property and it's owned in an LLC. So I think outside of the tax conversation, it does add just that a little more maybe anonymity. Maybe something to add to the earlier conversation when we started talking about deductible expenses is the difference between a deductible expense like insurance premiums, repairs, utilities, homeowners association dues, all of those things, and basis in the property. Basis is your after-tax dollars that you put into building or purchasing or significantly repairing your property. Big remodels and that type of thing. That gives you basis in your property, whether it's your primary home or if it's the DADU or if it's a rental property or vacation home. It doesn't really matter what. Your after-tax dollars that went into that property uh, generally speaking, establishes your basis. So then when you go to sell that property later, the difference between that sales price and what you originally paid to construct or to buy your property, that's your gain, your taxable gain. So whether you rent a room in your house, or if you have a home office in your house and you're depreciating the home office, or you have a DADU and you start to depreciate the property off the basis, there might be some recapture, but really tracking that purchase price and significant improvements, that's going to be really key in terms of determining whether there's taxable gain in the future or not.
One thing I would say is absolutely involve your accountant in the beginning with all of that, so that they can help you with the planning of that. And of course, if you have a financial advisor, they should be involved as well. But the biggest, most important person to include is your accountant.
A DADU can create value, but it also requires a significant upfront investment. Catherine, are there situations where you would actually not recommend moving forward with a DADU as part of someone's financial strategy?
Yeah, obviously, like I said, when there's issues with liquidity and you don't have a lot of other liquid assets, and again, that exact percentage really just depends. That's a more quantitative aspect to this, but there's a qualitative aspect that it's work, and you do have somebody, if you're planning to rent it out, you do have somebody living on your property and presumably fairly close proximity. So that's something it's not necessarily a reason not to do it, but just recognize that as you get older, if you're planning on trying to age in place, you may need to hire somebody to help you with that work. Or even now, if you're working full time, you may need to hire somebody to help you manage it. I think a lot of times people don't realize how much work it is.
From a tax perspective, Airbnb and VRBO have gotten very popular. The short-term rental concept, right, where we rent kind of like we're not a landlord, we're more of like a hotel runner, right, an operator, owner operator. And so there are some significant differences between long-term rental and short-term rental when it comes to the taxability of it, as well as these passive activity these loss limitations that long-term rental landlords kind of experience. And so if there are, homeowners that are creating DADUs or having short-term rentals just in general, recognizing those differences and potentially the ability to have active losses rather than passive loss limitations when they're in a short-term rental situation, the income revenue potential of a short-term rental might be much higher than the stability, the comfort and stability of a longer-term rental. So lots of differences in the rules when it comes to VRBO and Airbnb and other short-term rental situations.
I really appreciate that distinction between passive and active income and what the implications of that can mean. So I think it is different for each person, or even it can vary depending on what phase you are in life.
Let's look at a little further into the future. Families sometimes think transferring the property to their children early is the simplest solution. Chris, what are the main tax differences between gifting a property during your lifetime and having someone inherit it later?
The biggest difference is going to be the opportunity for a step up in basis. We talked about that basis issue. Well, especially if you're retiring in place and you have been in your property for quite some time, we've seen in our area appreciation on property being pretty significant. And if a person gifts their property to their children or other heirs, they're gifting the basis at the time that they've made that gift, and they have to then furthermore, they have to do a gift tax return, and they don't pay tax generally, but they'll file a gift return to report the gift, and it basically eats into their lifetime exclusion. Well, assuming that they haven't tapped into that, when they gift their property, they're gifting it at the value, but the recipient of that gift is inheriting the the basis. And so when they go to sell the property in the future, they're going to report gain, capital gain, or what have you on their tax returns. If they wait and then someone passes away, then when that property is inherited, they inherit it at the fair value. And so it avoids sort of the capital gain associated with that property, because they're receiving it at the fair value, and that establishes their basis when they receive the property in the inheritance. That's the most common way to look at it. Now, Washington State has a pretty expensive estate tax in it. So, there's other considerations and planning matters that might go into the decision to whether or not it makes sense to gift or not gift. But most of the time, inheriting property in the hands of the beneficiary is going to be more tax advantageous to wait for that step up. The other interesting thing is that, when you're in a situation where you have a married couple, they own the property as community property, and then the first spouse passes away, the property in Washington State is stepped up to the fair value. It establishes the new basis for the surviving spouse. And so there's some planning opportunities right around the sort of first spouse to pass away happens because of that step up, and then gifting it into a living trust or a surviving credit shelter trust or something like that. When you gift, it's a full gift and you lose rights to the property and its control.
Yeah. Yeah. The main reason, at least that I see, why people give assets during their lifetime is to get them out of their estate so that the growth and the appreciation happens outside of their estate.
Washington State has been all over the map in terms of what they are doing with estate taxes. So it was $3,076,000 up to June 30th, 2026. And then for us that are still alive and if you pass away between July 1st of 2026 and today, it went back down to 3 million, but they've changed the tax brackets. They ramped them way up. We were the most expensive state to pass away in, if your estate is greater than 3 million. So they've brought it back down to 3 million even, and then they changed the tax brackets. So it's still expensive, but it's not as bad as it was if you died June 30th or before. Ultimately, just think if you have an estate, total value of your estate is more than 3 million, you have an estate tax filing requirement.
This is our final episode of a series of 8 for the summer podcast, and we've appropriately called it Death and Taxes. And I mean, I think it's the only inevitable that we all face, right? And so our goal is to share knowledge on how to enrich our lives through architecture and design and proper planning overall. Like you're saying, it's very personal. We're talking about, for the most part, our personal home properties and how to potentially get more out of where we live financially. I think it also promotes better middle housing, which creates a positive diversity and density and thoughtfulness within our communities. There's so many intangibles that come with the subject matter. As architects and builders, we know how to do it in such a way that makes it comfortable to have someone rent a portion of their property and maintain privacy and look at ways to potentially meter the utilities separately for better bookkeeping and enhance. It's intended to be an enhancement. And so what I always fear is what I don't know when it comes to the financial and tax implications of what we do. And so I'm super appreciative to have your insights and knowledge so that when we are guiding our clients through this process, that they have that full, well-rounded picture and are making proper and informed decisions for themselves and for their families, for their legacy, for their community, for their neighborhood. It's kind of all-encompassing intention that we're trying to put out there through this very important information. So yeah, this has been a great conversation, and I think it is rounding us out. And I'm very appreciative for your participation.
There's a lot to think about beyond simply building a DADU. The financial, tax, and long-term planning decisions can be just as important as the design itself. Suzanne, Chris, and Catherine, thank you for joining me and helping us better understand these conversations. This podcast has been such a good experience for me, and I've learned a lot from our guests, our team, and from putting each episode together. And a special thank you to Delaney, who helped me so much with the recording and editing behind the scenes. I really appreciate all the time and work you put into making these episodes happen. And thank you to everyone who listened and followed along throughout this series. We hope Do You DADU gave you a better sense of what's possible in your own backyard, and maybe even inspired a few ideas of your own. Thanks for being part of the journey with us.